What's going on, all my mogul makers? It's your boy, Mr. Mogul Maker, Antonio Cook. I've decided to come back for yet another episode. Today, I want to talk to you guys about the multiple ways to raise capital. I personally believe that every entrepreneur needs to keep their eyes on every which way to raise capital. The cash flow through investing and through bootstrapping, through donations and raising capital. We're going to go and explore every one of these aspects of capital raising. You know, I'm a little long-winded, so I'm really going to talk about all the details and everything about capital raising, right? If you're an entrepreneur, if you're an investor that's interested in raising capital, you want to stay tuned for this video. Like and subscribe. I'll see you guys on the other side. Okay, so again, welcome back to another episode with Mr. Mogul Maker. Today, I want to discuss capital raising with you guys, strictly about capital raising. This is one thing that's super critical for entrepreneurs. And again, forgive me for my background. I just checked into my room, finally got a chance to get settled down. I'll give you guys a view maybe later on or something. But capital raising, in my opinion, is probably one of the most daunting tasks for entrepreneurs to be able to keep their eyes on, right? A lot of times we get so embedded inside of our product and our services that we offer that, you know, we get kind of caught up in a lot of the R&D, the research and development of the company. And oftentimes we get also so caught up in the marketing inside of the company so much that we kind of lose sight of all of the other things and other aspects of ways we can raise capital. Today, I'm going to break down some of those methods of capital raising. So number one, and it's usually for brand new entrepreneurs, where we start at is usually bootstrapping, right? This is like the self-funding phase, the funding where you're like personal savings, 401k, home equity line of credit. If you own a house and you want to pull a HELOC out, if you need help doing that, you reach out to me. Personal credit cards or loans. This is usually the early stages of any entrepreneur, any business owner. And again, just so you're aware, that's called bootstrapping. That bootstrapping phase is probably the most riskiest, most dangerous phase out there. You're risking a lot of you personally, right? You're risking a lot of things that has to do with like your personal assets, and you turn your assets into liabilities because you're trying to bank on a business that is unproven. Now, I will say this though, a business that is unproven at the same time needs to be a proven model before you start to get to some of the higher levels. All right. But there are ways to kind of avoid utilizing so much personal liability up front in the bootstrapping phase. So early stages, I always kind of suggest to my clients and my people, if you're going to go in, especially if you have any 401k, if you have any HELOC, you have personal credit cards, you have these other things, one of my biggest suggestions are take that and start building up the corporate credit first. Then use as much of the corporate credit, exhaust as much of that as you can during the bootstrapping phases. So here's some examples. There's companies that are out there that will actually give you a line of credit for marketing. They'll give you a line of credit for merchandising. They'll give you credit cards for, people like Sam's Club, Walmart. They'll give you access to capital to be able to shop with them and get your equipment and these early stage things. And again, it's fine if you use some of your personal money to pay those bills back, but the way that you kind of avoid that liability, in my opinion, is start off with worrying about the corporate credit. Even if your personal credit isn't there, but you have a little bit of cash to work with, start off with the corporate credit. Use the corporate credit because it separates liability. Remember, this is a liability game, guys, right? The objective of not only building up a cash flowing system, a machine that builds wealth, is also protecting yourself from liability, protecting your assets. You guys get the point. All right. So the next phase, usually thereafter, part two the next phase would be debt capital, right? Debt capital is the second level of the game. So that's like business credit cards, HELOCs, like lines of credit. Usually you can start going after SBA loans. This is typically after your business is 2 years old. And I'm going to teach you guys a way to hack that. But this is typically after your business is 2 years old. And usually organically after a while, you've kind of developed not only the personal credit, but you can become a personal guarantor for your business, right? I say simultaneously, you should be using corporate credit and PG credit at the same time. This will increase your ability to get things like, of course, like the business credit cards. That's usually going to be the very first phase of stage two. So the very first phase of stage two is business credit cards. When you PG and you stack 0% business credit cards. Then lines of credit. That's a little bit more difficult to qualify for because a lot of times they need cash flow to show that you generated cash flow in order to qualify, but that's one of the next phases. The SBA loans, please do not ignore the SBA unless you just don't like dealing with government. If you don't like dealing with the government, okay, I got it. But the SBA really has some really lenient programs. And listen, everybody that was out there running it up for PPP, you know why the SBA is so easy to get money from. It isn't only the PPP that you can get money from. 7A loans, 504 loans, and a bunch of the other programs. Look into the SBA. In fact, I'll probably do another video where I'll just go over everything about the SBA. Term loans. On the business side, on the personal side, you have personal loans. On the business side, you have what's called term loans. So banks and fintech companies. So banks usually do provide you that, one, because you already have previous strong personal credit, and you also have been established for a couple years. And I'll go over some of the other data points. But then fintech companies, they'll usually provide you a line of credit, or they'll provide you a term loan because you have cash flow, right? You have cash flow. Cash flow will get you that all day long. All right. Merchant cash advances. This is another one that's really important in the sense of you already have a lot of merchant transactions. Stripe is usually good for this. Square is good for this. And there's a bunch of other companies out there as well. I'll have some listed below inside of the description so you guys can actually see some of the merchant finance options. Invoice and equipment financing. Depending on the company type that you're in or whatever you're doing, invoice and equipment financing is the direction you want to go. People like myself, private bankers, again, I discussed this in another video, but people like myself, I'm representing my client, and sometimes my client needs funding of a different size, but they might not have the criteria that qualifies for actual cash loans. So sometimes we will liquidate an equipment loan. What I mean is, yes, you heard it correct. You heard it here first. I will get the equipment and I will liquidate it by selling off the equipment. This is legal. A lot of times banks and institutions look at this like this is unethical, but there is a very ethical way of doing this and managing this by just simply still making your payments on your loan. The objective of this, you guys, is to build up more of the business and your asset column. That is the objective of anything that we're doing. So invoice financing or equipment financing, again, we can get really creative with that because those are usually based on an asset, meaning the asset is the equipment or the asset is future revenue off of the invoices. So peer-to-peer lending, places like Lending Club and Prosper, great places to go to for peer-to-peer lending. So private lenders, let's say, for example, this is a quick hack for anybody that has a interest-only credit card for 18 months, right? Take your own interest-only credit card, sign up for Lending Club as a lender, right? You can give somebody a short-term loan for say 6 months, 9 months, and they will pay you back a high interest rate, let's say 20%. And then off of that interest rate that you get paid back, you've actually made a profit on the credit card before you even have to start paying interest at the 18-month point, right? So you can literally use your business credit cards to be able to start doing private lending as well. Lending Club, Prosper, those are just a couple sites. Look up some other ones that are kind of in the same ballpark. They're great for businesses with like revenue. All of this is like good for businesses with revenue. If you have a couple assets, you've learned how to manage debt pretty well, whatever the case may be. I don't like to jump my clients into stage 2 until we've kind of mastered what's going on in stage 1 in the bootstrapping phase. All right. Depending on what their business model is and whatever they're trying to do. All right. So step number 3, equity capital. Trade ownership for growth. This is a unique phase. The reason why it's unique is because this is also how you can build your team. This is how I've built my teams over the years. I've managed to build 6, 7, and 8-figure companies around me over the years, but I've been able to do this because, and oftentimes I get really quality level management involved because I'm trading equity for their involvement. So one, that's like team building. Right. Then, of course, you want to actually sell off equity in the company. And then in the equity building phase, as far as like selling off capital or selling off equity inside of your company, these are some of the players that are going to want to buy from you if you've made this into a machine that is entertaining enough for them to get involved. Angel investors. All right. These are different investment companies or different investment types. An angel investor is someone who is an accredited investor. All right. Let me break that down really quickly. An accredited investor is someone who has done $250,000 for 2 consecutive years, or they're someone who has $1 million and or they have $1 million in net worth, net, not gross, net worth, not including your primary home, right? And or, because it's considered both, they've made $250,000 a year for 2 consecutive tax years, all right? That is the legal definition of a accredited investor. And no, I'm not an attorney. I don't propose to be, but I'm just giving you guys a little bit of insight. Take this as entertainment. This is not legal advice, all right? But that is how it is described as an. Now, here's another jewel as to who was also considered an accredited investor. The great Robert Kiyosaki, and again, shout out to this guy because I studied him for years, but he called it the inside investor. Now, what the SEC considers to be what he would call an inside investor is someone that has been inside of the company, who has a sense of expertise and can also has investment capacity within the company. All right, let me break that down, make it very simple. There's a reason why somebody like Mark Zuckerberg or Grant Cardone Cardone or Warren Buffett, and again, you name the billionaire, they are also accredited investors. Before they became accredited financially, they were accredited simply because they were involved in the company at the capacity. They're founders of the company. They had the IP, they had the intellectual property that was qualified for them to make a decision, an educated decision on if the investment was something. So again, they also qualify as an angel investor because they are a part of the company that's being invested into. I hope that didn't go over you guys' heads. All right, angel investors. So another one is venture capital, right? Venture capital companies, they're often companies that will get involved for the sake of immediate scale. A lot of them are looking for unicorns. And if you don't know what a unicorn is, just again, look it up. They're looking for the type of companies that are going to be super special. They're looking for Uber. They're looking for Facebook. They're looking for Google. They're looking for the companies that are able to fly out of the stratosphere, right? And typically you have VCs, companies like Sequoia Capital, amazing company, who invested, I believe, into Facebook, Google, and some of the companies early stage, but they're usually an early stage investor. Now, not all VCs are looking for unicorns that'll go IPO. Some VCs are looking for companies that, they can 10x or 50x or 100x their return. They're just looking for that, and then they're willing to exit. And some of them will exit straight to what the next one is, a private equity firm. So private equity, they're usually looking at holding on the companies. They want to buy into you and they want to hold on to you for 5, 10, 15 years, and then they want to exit. And a lot of times with private is they will not only buy you, but they will buy your competitors and everybody around you, package you all together in what's called a merger, not just an acquisition, right? And then they'll sell it off as a complete package, right? To maybe another private equity, or they'll exit it to the public markets. So friends and family round is another group of people that could potentially invest into you. But listen, from where I come from, friends and family are just not options. So if you guys got friends and family that actually got deep pockets like that, and you actually put together a proper private placement, and I'll get into another video about private placements, bonds, and instruments, MTNs, and all the other stuff. I'll get into all of that good stuff for you guys later on. But friends and family would be one of the first people that you bring this to, because you can't solicit an investment of that size to people that you don't have pre-existing relationships with. But again, there's some more hacks about that too. But I'll talk to you guys about that when I bring up the video about private placements. I'll do a whole video about it. Strategic corporate investors. Strategic corporate investors. Now, you might have somebody that has a partnership alignment where it just makes sense for this corporation to get in bed with you and your company because the alignment makes so much sense, right? So think 50 Cent and Reebok. The alignment just made sense. And that was more of an endorsement play. But again, let's say Jay-Z and Reebok, 50 Reebok, and some of these other people, they had a 50-50 split. That's a partnership. I don't care. It's not an endorsement. That's a partnership. All right. And again, it's what you're seeing out of Douce and some of these other liqueurs and other deals where you see Rick Ross and some of these other people. What they're doing is partnership deals. They're no longer doing endorsements, right? So sometimes strategic corporate investors can be the perfect partner to help you raise equity capital as well. You might not split equity in the company, but you might split equity in the offer, right? If that makes sense. Equity crowdfunding, Wefunder, StartEngine, and there's so many of these other crowdfunding companies. Listen, if you have the type of company that you feel like you want to get listed with a crowdfunding, I personally have a couple friends inside of that game. Let me take a look at the company. I love to make an assessment on my end. Look, I'm nobody perfect, but I love to make an assessment. If you guys have something, bring it my way. And I love to talk to you guys about it. We do have some equity crowdfunding companies that I'm personally close inside with. Alternative and creative capital. Let's talk about some of this stuff. This is number 4, alternative and creative capital. Revenue-based financing. Financing based on your current revenue. All right, so the hack that everybody wants to hear. Manufactured revenue. Again, it's not illegal to manufacture your revenue. It's not illegal to purchase your own stuff, as long as you're using separate persons. And I mean the legal separation of persons. You as an individual are not your corporation. So if you and an individual buy up your stuff, you have manufactured your own revenue. And that is very legal. Again, it's unethical. So you guys got to be careful about how you handle that. Royalty financing. If you're an artist, music, entertainment of some sort, if you've got any intellectual property that's being used constantly, then you might have royalties that are either projected to come or that are already coming in. You guys, there's plenty of financing companies. I'll drop a few guys. You can go purchase someone else's royalty rights from someone and you collect the financing off of it. But that's a whole other story. Product pre-sales. So if you're going to do some pre-sales, Kickstarter and Indigo is kind of like the gold standard. If you want to do, some of that, you also can kind of create a hype. I would hire a publicist to do this. Product pre-sales, hire a publicist to get you a lot of press, a lot of media attention. So you don't have to pay for all the attention and all the eyeballs, then turn that into pre-sale revenue. All right. Crypto and token offerings, ICOs. I don't personally subscribe to them, but it is an option. I have a whole video strictly about grants. You guys just got to wait on that, but I will start to put some links below this description for it. Trade credit, vendor financing, joint venture and licensing rights, purchase orders, and or factoring. So again, I'll kind of go over like trade credit and vendor credit. That's more like Uline and Granger and whatever the case may be. Now, there are much larger companies that offer that same type of stuff as well. But institutional capital and market funding. This is when we get into the game of IPOs, DPOs, Regulation A, which is what's considered like a mini IPO, SPAC mergers, bond issuance, private placement memorandums. All right, now an IPO, initial public offering. All right, there's only one version of it, actually, but again, that's what we are famously come to hear about. Brand new companies coming out and they're going to IPO. That wasn't the direction of Berkshire Hathaway. Again, Warren Buffett's kind of like one of my favorites out there. That was not the direction of him. And then by the time Charlie Munger got involved, rest in peace, they had already been publicly listed. Now, how did they get publicly listed? They did what's called a reverse merger. So their private company bought out a public company and merged itself together with the company that was already publicly listed. These are the ways, guys, that we can really create empires. Kind of frustrates me sometimes is when I hear people on other platforms that are talking about all the problems, but no one's giving solution. Has anyone ever discussed the potential of us putting together a fund that eventually decides to do a reverse merger to get publicly listed so we don't have to go through so much scrutiny with the damn SEC? I'll get to that another day. DPO, direct public offering. So this usually a direct public offering, it's not as public as it seems, but this is more like an over-the-counter market. So there's a marketplace called the OTC. In the OTC, there's a lot of offerings, and the offering is equity. Put together your PPM, you provide it to your banker sells it off to the customer base that the bank has. And listen, Merrill Lynch has way more customers than you have contacts, okay? I guarantee you that. So you want to go to Merrill Lynch and have them deposit your private placement, your PPM, and do an offering to people that they know, because again, you can't do an offering to anybody you don't have a pre-existing relationship with. Bond issuance. Listen, if you don't already have cash flow coming into the company, don't even worry about this. And I'm talking about profit, nice size profit margins too, because when you're doing a bond, you're essentially doing a syndicated loan. You're creating this package of people. You're creating this package and then you're selling off these individual coupons to all these different people to raise capital as a loan. And you're promising them that you're going to pay all of these mounds and mounds of people back with a loan. If you don't have previous loan history, if you don't have institutional loan history, if you've never paid back a credit card, don't worry about this phase. You're not ready for that. And then again, like I said, private placements is the instrument that you use in order to help you raise capital. I'll try to bring like a securities attorney. I got a couple of securities attorneys friends who create these PPMs. They do a lot of Reg D, Reg F, and of course I'll explain all of that in another day. Now, grants are another form that us as entrepreneurs have to keep our eyes on, right? We have to keep our eyes on grants. So literally you want to almost put together a division of people to help you create or do grant writing and grant proposals. Now, where can we find some grants? What is it? The SBIR, STTR. These are like more like tech and innovation grants. The EDA, these are regional development grants. USDA, they're rural development grants. MBDA for minority business owners. FedEx small business grant. Imagine that. FedEx is, shout out to Fred over at FedEx, the CEO or the founder of FedEx for the small business grant. Ladies, did you know that Visa offers a grant called Brunch Foundation? All right. These are just a few that I decided to find. Me and ChatGPT got together and we kind of dug up a few things. State and local government agencies. Again, so if you're going to go after state and local government, then you need to sign up for SAM.gov. I'll have another video about the grant proposals and grant writing and also registering with SAM.gov. Nonprofit and foundation grants. So Ford, Gates, the Bill and Melinda Gates Foundation, those are foundations. And just really quickly, the difference between just a normal nonprofit and an actual foundation. So you have an organization and a foundation. And the difference between the two is the organization is the one who actually performs the act. The foundation is the one who raises the capital. They could do one and the same, but the reality of it is when you see such and such foundation, they don't actually do anything. All they do is raise capital for other organizations. All right. So hopefully you guys can create that distinction in your mind. And then donations, crowdfunding platforms like GoFundMe, GiveButter, a couple of things again, me and chat came up with. Creator tools, Patreon. I will have a Patreon channel up pretty soon, but I'm still working on some of my exclusive content and some of my actual courses. I can't wait to give you guys. Buy me a coffee and then Ko-Fi. Fiscal sponsorship. So you can partner with 501c3s to accept tax deduction donations, which is pretty dope. Like if you do a program, you can have them be the 501c3. If you need help setting up one, you can also reach out to me and schedule a consultation. I'll walk you through it. But you could also do that. And then you could partner with somebody that's already established established who already may have the reputation. And then, you guys could put together a campaign together. And again, I would hire publicists for that if you guys are going to do it. Community drivers and local donor programs. Again, pretty dope. So one of the last jewels that I have for this, and I'm going to go ahead and wrap this up with you guys, is corporation stacking. I called it corporate stacking. Everything you're thinking about doing with one business, I want you to multiply the idea with 10 more, right? Well, 9 more, so you can have 10. Right, so 9 more companies. Multiply the same idea. So a great lady friend of mine, she had a food truck company, right? And with the food truck company, again, and she's kind of one of the ones who kind of birthed this idea with me, but she was thinking to herself, and I thought this way when I had my trucking company, you multiply that almost like in a franchise. She made it very clear to me, if I get, these 9 more trucks, and now I've got 10 trucks out there, the amount of revenue is not only 10 times more, it almost becomes 20 or 30 times more. Well, it's just because you're now multiplying not only the efforts, but the efforts are not equal all the way across the board. So here's what I mean. 1 truck might do the equivalent of 3 trucks, but you never know exactly what that 1 truck is going to do. Only 1 truck can go to one place at one time, right? But if you start putting businesses or your trucks, you start putting your businesses in this case in different locations or in different situations, all of a sudden you end up having a stronger outcome. How many of you have managed to set up a business out of Montana and purchase vehicles out of Montana where there's no state tax and no sales tax? But why not? Right? How many of you have your businesses that are not in Texas, but have foreign filed your businesses in Texas and then tried to test how much funding you can get in Texas outside of the state, whatever other state you're inside of? Then you realize how sweet Texas is for funding and capital raising, right? Again, when you multiply your efforts, you multiply your outcome. So all the capital raising methods that we just discussed, I want you to think about how to corporate stack those. No LLCs over here, only corporations. All right. All right. So hopefully I've left enough information on you guys' heads and you got some value out of everything that I'm saying. I look forward to seeing you guys on the next video. I'm probably going to do another one here in the hotel. I'm just kind of in Los Angeles right now, floating around. John Tay and I kind of putting some things together for you guys. But listen, like and subscribe if you guys got any value. I want to hear your comments. What capital methods are you guys using right now? What ways are you guys raising capital? Listen, I come from hustling days, okay? So there's nothing in the comments that's going to bother me one iota, all right? I want to hear what you guys are doing, what you're up to, and then whatever you're trying to accomplish. Hopefully I can be a liaison or be some type of help for you guys getting to the next phase of your path. Mr. Mogul Maker, I am out of here.